Warren Buffett's Berkshire Hathaway just dumped its entire stake in Domino's Pizza, and it sent absolute shockwaves through the market. I mean, when the world's most closely watched value investor suddenly bails on a stock, you better believe Wall Street pays attention. It sets up this massive tension between pure market panic and what's actually happening inside the business. Is there some fatal flaw hiding in the dough? Or is the market wildly mispricing one of the most efficient economic engines in the entire restaurant industry?
Because of this fear, Domino's forward earnings multiple just compressed to 17 times. That is a decade low. Think about the sheer scale of that drop. For years, this company traded at a massive premium because investors viewed it as a high-growth tech company that just happened to sell pizza. But at 17x forward earnings, Wall Street is basically asking if the core engine is permanently broken. To figure out if they're right or if they're completely missing a fundamentally sound business, we need to look past the panic and understand how Domino's actually makes its money. So let's clear up a massive misconception right out of the gate. Domino's isn't really a traditional restaurant company. Not at all. It's actually a highly profitable, asset-light, vertically integrated supply chain and royalty machine. Over 99% of its 22,500 global stores are franchised. Look at that massive $731.7 million slice for the supply chain. They are literally selling fresh dough, cheese, and equipment to their own franchisees on a totally predictable cost-plus margin. Combine that with pure profit streams from U.S. and international royalties, and you're looking at a company carrying virtually zero direct restaurant operating risk.
And this structure, it creates an impenetrable moat. They operate 26 captive supply centers across the U.S. and Canada. And because they're one of the largest agricultural buyers in all of North America, their commodity purchasing power is massive. They keep ingredient costs lower than any independent pizzeria could ever dream of. On top of that, franchisees chip in 6% of gross sales to a national advertising fund. That creates a marketing scale barrier that smaller competitors simply can't replicate. And the whole thing is tied together by their proprietary Pulse digital ecosystem, locking both franchisees and customers into the platform. Section 1. The Q2 2026 conflict and why Wall Street panicked.
Here's the financial tension broken down. Now, top-line revenue actually beat expectations, coming in at nearly $1.2 billion. But underneath that, the engine sputtered a bit. Diluted earnings per share missed consensus by 10 cents. And then we have U.S. same-store sales, arguably the most watched metric in the restaurant space. It essentially flatlined at just 0.1% growth, missing the target of 0.62%. For a company whose entire growth narrative is built on high-volume store throughput, a flatlining domestic market triggered immediate alarm bells. But the real issue was hiding just under the surface. On the earnings call, CEO Russell Weiner admitted something crucial. People were still ordering pizza. Total order counts actually went up. The miss was driven by a frightening drop in average transaction ticket sizes. Management pointed directly at misfired promotional messaging on their sliced sauce platform and just poor marketing execution for their premium menu items. Customers were still buying, they were just spending less per order, and that immediately threatens franchisee unit economics. Which brings us to the market's deepest long-term fear, and this goes way beyond just a bad quarter of marketing. Historically, Domino's held an absolute monopoly on fast, cheap delivery, mainly because mom-and-pop shops couldn't afford their own drivers. But look at the shift. Third-party apps like DoorDash and Uber Eats have completely democratized delivery logistics. Today, a local independent pizzeria can offer that exact same fast home delivery. Domino's historical moat, having a guy in a car with a hot bag, is simply no longer exclusive to them. But wait, here's where we need a sharp reality check, because the contrarian bull case here is incredibly compelling. While the market is hyper-focused on aggregators and Berkshire bailing, inflation is absolutely crushing Domino's direct national rivals. Higher labor and food costs have squeezed franchisee margins at Pizza Hut and Papa John's so badly that it's contributing to roughly 450 store closures across those two brands in 2026. And while they retreat, Domino's is leveraging its massive supply chain scale to steadily capture market share, now holding 23.3% of the U.S. quick-service pizza market. Section 2. The Qualitative Scorecard. Let's find out if the engine is permanently broken.
When we synthesize the qualitative health of the business, looking at market position, viability, and revenue quality, we get a highly resilient blended score of 8 out of 10. And the absolute anchor here is profitability. Domino's operates with an ultra-high 19.3% operating margin. That's its way above fast food industry averages. Their ability to generate pure franchise royalty streams while capturing margins on their captive supply chain gives them a level of financial flexibility that most restaurant chains simply do not have.
And management absolutely knows this. They are aggressively taking advantage of that depressed 17x valuation. In just the first half of 2026 alone, they repurchased over $231 million in stock. Even better, they're armed with a massive $1.23 billion war chest to continually shrink the share count. They're positioned to retire roughly 1.5 to 2.5% of their outstanding shares annually over the next 5 years. They are literally using the market's fear to engineer higher future per-share earnings. And by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed.
All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, quality businesses built to compound for years; hidden gems, under-the-radar names with asymmetric upside; and dividend hunters, durable income with the fundamentals to back it up. Premium also gives you Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. Section 3. The 5-year scenario framework. Valuing the future. Now, before we look at the numbers, I need to state clearly, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. The math across these 3 scenarios is super compelling. From our July 20th entry price of $328.71, the 55% probability base case implies a target of $524.07. The high case stretches all the way up to $753.33, while the low case drops to $296.35. When we blend these with their probability weightings, the target price sits at $535.84. That implies some significant asymmetric upside. But that upside only materializes if management can execute on some very specific operational conditions. So let's look at the crucial assumptions driving that base case. To justify expanding the multiple back up to 22 times earnings, Domino's needs to hit a 4.5% annual revenue growth rate over 5 years. This requires a modest recovery in same-store sales to 2.5%, a steady pace of store fortressing with about 175 new U.S. and 800 international net stores annually, and supply chain margins stabilizing at 19.5%. If they can maintain that operational tempo, the math works out beautifully. But we definitely have to respect what has to happen for the bear case to materialize. In this scenario, those third-party delivery apps permanently steal transaction share. That shrinks franchisee cash flows, effectively capping U.S. same-store sales at 0.5%. Under that heavy operational pressure, operating margins compress down to 18.0%. That slows down free cash flow generation and throttles the share buyback program. If growth stalls out like this, the market will permanently re-rate the multiple down to 16x, leaving the stock languishing around $296. Section 4. The risks. What could actually break the thesis? The biggest vulnerability hiding on the balance sheet is leverage. Domino's operates with massive securitized debt, $4.88 billion of it to be exact. Now, while their cash flow easily covers current interest, if capital markets face prolonged high interest rates, refinancing that burden as it matures is going to lead to higher interest costs that directly cannibalize free cash flow. Add to that the fact that their core lower and middle-income consumers are facing a severe discretionary spending squeeze from inflation, right alongside the constant threat of raw commodity price spikes in wheat and cheese. There's also a major short-term execution risk that we just can't ignore: an upcoming leadership transition. CEO Russell Weiner is retiring, handing the reins to current COO Joe Jordan in October 2026. While Jordan is a 15-year veteran of the company, this changing of the guard is happening at the exact moment Domino's desperately needs to fix its promotional pricing strategy and reverse those shrinking ticket sizes. Any strategic slip-up or delay in rolling out new marketing campaigns during this transition could really stall same-store sales. Ultimately, everything comes back to this core takeaway: the Domino's flywheel. The entire survival and growth of this business relies on massive transaction volume. High volume protects those supply chain efficiencies. Those efficiencies fund unbeatable consumer value promotions. And that value proposition drives the franchisee profits that fund the construction of new stores. Basically, if the volume breaks, the whole flywheel breaks.
So, we return to the central tension. Did Berkshire's exit blind the market? Is Wall Street severely mispricing an incredibly durable, asset-light cash machine just because of a short-term promotional hiccup and a fear of delivery apps? While the debt and aggregator threats are definitely real, Domino's is quietly gobbling up market share while its competitors literally close their doors, all while aggressively buying back its own stock at a decade-low valuation. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.